ahead and share my screen. And let me know. I think this should be good to go here. All right, can everyone see my screen? Looks good. Okay, perfect. All righty. So today we are going to be covering primarily the tax updates for 2021. I'm really excited to be able to kind of go over really the big topics here are going to be COVID related credits, tax credits, as well as any grants or loans that might have been received. But before we get into that, I would like to quickly go over the different type of entities that you have, because this will determine how you're going to file your taxes at the end of the year. And I do know that everyone might be in a different stage of their business. So I will go ahead and get started with going over the sole proprietor, which is our most common type of entity, also known as LLCs. And this is usually when all of the business income is taxed under the personal tax return on Form 1040. Keep in mind that in regards to the internal revenue, they will still consider you a sole proprietor, even if you have a LLC. Whereas in the state of Washington, if you are an LLC, they view you as a corporation. But I did just want to make that clear, just because if you ever call the IRS, you're still a sole proprietor, even with an LLC name. Second one here is going to be the multi-member LLC. And this is usually when you have a partnership where you and your partner are not the spouse, or you don't usually file your tax return together. So this is when you will have to file the business taxes on a separate form called 1065, and everyone, the members will then assign themselves a K1 to then transfer over to their personal tax return. The last two are not as common, but this is where I will still touch bases on the S corporation and C corporation. The S corporation here will use tax form 1120S, and it is required that if you do become an S corporation as an owner, you must pay your salary on a W-2. You as the owner have to put yourself on payroll. And I do want to also point out here that you can start off as an LLC / sole proprietor. And as your income increases, this is when you want to start talking to your accountant. That is when you can elect to be taxed as an S corporation. So you can still keep the LLC name, but you can be taxed as an S corporation or C corporation. So very important to know that these last three options that we're going over, the multi-member S Corp and C Corp, their tax deadlines to file is going to be March 15th. Very important to know that, because there are very hefty penalties for not filing those returns on time. So again, S corporation, you can select to be this, but it's important to know that you do have to pay yourself a reasonable salary. And with the C Corp, this is a bit different than the S Corp. I won't get into too much detail with this, but it is good to, when you're considering maybe corporate status with the IRS, talking to your accountant to figure out which one would best fit your company. The biggest difference between the S Corp and C Corp is that the C Corp has what's called double taxation. You pay taxes when you file your corporate return, and at a set rate of 21%, and then you will be taxed again on your personal tax return. So this one is not very common for smaller businesses. This is usually what you'll see, like a bigger corporation like Amazon or some of the bigger companies are usually all C Corps. So again, these are the type of entities. I always kind of like to start by going over this information so you get a better idea on how you will file the return. And because I am assuming that most of us here are probably filing as a single member or an LLC, I do want to briefly talk about your federal tax liability as well as your self-employment tax liability. It is important to know that you will have to usually pay these taxes when you file your annual report at the end of the year. And I try to make this as easy to understand why we pay these taxes, where these taxes are going to. And the first one is the federal tax. And this is basically calculated after you figure out your filing status and your tax bracket. It is important to know that this is a tax that's paid for, we have our roads, libraries, public parks, etc. So this is just something that it's our obligation to pay here. And it is a progressive tax rate. So on the right-hand side, I have the tax brackets for 2021. I would like to give a brief example to try to make this a bit easier to understand. It is important to consider that the percentages that you see on the right-hand side, or I'm sorry, on the left-hand side, are calculated after we deduct your standard deduction. So I'll briefly explain what that is. The IRS, whenever you're filing your personal tax return, will deduct a certain amount of taxes from will deduct income from your tax responsibility, and it's all based on your filing status. So at the bottom here, you're able to see that we have 4 different filing status. There is actually a third one, which is widow. Not very common, but the widow standard deduction will be the same as the married filing jointly, which is our second one right here. These are the deductions for 2021. They do change every year, not by a lot, but they do change every year. So I'm going to do a brief scenario where we have a single filer who has a business that net income for the year after expenses were calculated was $20,000. So assuming I am a single member LLC, my business net income after expenses was $20,000. So to kind of explain how much in federal taxes I would pay, I would assume that that's my only income for the year. So I would have $20,000 income, and from that, I would subtract my standard deduction of $12,550. I won't get into too much detail, but you can also itemize your deductions if some of those deductions that qualify under your personal tax return exceed what the IRS is already giving you. And there is a whole list of expenses that you can put on there, but it is important to know that you cannot use those same expenses on your business return or your business expenses. But we're going to just keep it simple and assume that my personal expenses do not exceed $12,550. So I will then subtract that amount from my net $20,000 income. And that's going to leave me at a taxable income of $7,450. And once I get that final number, I will then be able to calculate my rate. So if I didn't take the standard deduction into consideration, I would have thought that I would be falling into the 12% tax bracket. But because this is calculated after the standard deduction, I'm actually falling into the 10% tax bracket because 7,000 is below the threshold of $9,950. Okay, it is also important to know that these percentages are accumulative percentages. So you can't just do 7,000 times 10%. It's a little bit more simple when you're in that 10% tax bracket, but when you jump up to the 12 or 22%, you do get taxed a specific percent for like the first 4,000, the next 4. So, you know, there is a whole tax table where you can figure out the exact amount of taxes. But again, it is important to consider this, especially for people who are married and might have their business, but their spouse has a W-2 job. This is all combined income if you are married. So again, it is important to figure out, you know, how much taxes your partner is paying if you are married. If you are head of household, for that filing status, you get a bigger standard deduction. And the requirement there is that you must have a dependent on your return and not be married. So just wanted to explain this, and this is going to be our first tax liability, and this is the federal tax liability. And this usually all is very similar for people who are also in that status of S corporation or C corporation that we talked about earlier. Everyone will usually be held responsible to pay the federal tax when filing their personal return. Okay, so we are going to then move on to our next tax that we're going to see. This tax is specifically for our single member LLCs. So a single member sole proprietors, as we said earlier, this tax is not going to be paid by people who have elected to be taxed as a C Corp or S Corp or partnerships. Okay, so this tax is only for our single member sole proprietors. And this is what's called your self-employment tax. Most of you, if this is not your first year filing, are familiar with this specific tax for people who are self-employed. And the rate is 15.3% on the first $137,700 of net income. Anything over that is going to have an additional 2.9%. And I've given the breakdown of how this tax is split up. You know, the total tax is 15.3%, but it consists of your Social Security and Medicare. So what this means is that you will pay this tax when you file your personal tax return, but this one will go into your retirement account, as I like to explain it. This is something that Social Security will have on record. So one of the things that I see a lot with people who are self-employed is sometimes they put a lot of expenses, or they don't want to pay a lot in taxes, but they're also not considering that what you are reporting is really what you're going to have as like long-term, benefits. So this is something that you always want to just consider. If you have been self-employed for several years, I always recommend to contact Social Security to check the record of how much you have, just to be better prepared for retirement. So again, this is a tax that consists of Social Security, Medicare, and it is usually paid at the end of the year based on your net profit. One thing that I do want to point out is that after 2018, they initiated the Tax and Cuts Jobs Act, which gave you a 20% deduction on your net income before calculating the self-employment tax. So that is a huge benefit that was given to self-employed individuals for 2018. They have not said that they're going to remove this. So as of now, you should still qualify for that 20% deduction, which is huge when it comes to the federal taxes that we're paying at the end of the year. So Those are the two taxes that are very common for those individuals who are sole proprietors. We have the self-employment, which is added on top of your federal tax liability. So here, percentage wise, for example, in that scenario that I am a single member LLC, my net profit was 20%. I would be paying 10% in federal tax plus 15.3 in my self-employment tax. Keep in mind that it is important that if you are expected to owe more than $1,000 at the end of the year, including federal or self-employment tax, the IRS does require you to make estimated tax payments to them, because if not, you will be penalized. So even though you don't have payroll and you're not paying your taxes quarterly, the IRS says if you end up with a balance of over $1,000 and you haven't made estimated tax payments for the year that you owe, then you will get a penalty for not doing that. So if you haven't made any payments to the IRS and you have a net profit, then it is important to, again, talking to your accountant or tax preparer to figure out a percentage of how much you can send every quarter. The penalty is not very high, though. I do get a lot of people who get a little bit concerned about this. The penalty is not very high. It's usually going to fall under 5% of what you owe in estimated in taxes. But that is something that I also like to let everyone know, that it is important to consider that during the year. And I know that that was a lot of information and I did that very quickly. But that first part of the power presentation is kind of just explaining our tax liabilities. We're going to go into the COVID related tax credits, and then towards the end of the presentation, I'm going to go over the business expenses that you can deduct. I'll go over the home office deduction in a little bit more detail. So I kind of want to have enough time to cover that, since that tends to be where a lot of people have questions. But right now, I would like to specifically talk about tax credits because of COVID. These are credits that were also eligible, that were also applicable for tax year 2020, and they have extended the credits for tax year 2021. So the first part of this credit is for people who have employees on payroll. So if you are a business who has employees on payroll, you are eligible for a refundable tax credit for sick leave wages as well as family leave wages provided to your employees. And I'll go into a little bit more detail about what qualifies under sick leave wages. They are refundable and they are available for certain periods when an employee was unable to work. And I'll cover that here in the next slide as well. But this is also for contractors or people who are self-employed. A lot of people always assume that these credits are only for bigger companies or people who have employees on payroll. This is also for people who are Schedule C filers, some 1040 filers that we talked about earlier. So for this one, you can also receive the credit for the same reasons, for sick leave wages as well as family leave wages, or any applicable qualified health plan expenses that you might have had to pay during the time of April 1st of 2020 until September 31st. The September 31st deadline was just updated. Originally, when these changes were made in January, they ended this credit for March. But because the pandemic is still happening, there were still a lot of people who, a lot of cases with COVID, they extended the credit or the time paid during the year until September 31st. So this is for anybody who could also, who is also unable to work or telework because you provided care for a child whose school was either closed or whose child care provider was unable to take care of them because of COVID. So this isn't just for your time off because of COVID, but it's also for taking care of any dependent who might have had to, who either school was closed or childcare was closed. And these are the things that we want to kind of spend a little bit of time here with. These are the reasons as to who would qualify for having the paid sick leave. So the first one being the employees under federal, state, or local quarantine. The employee has been advised by a healthcare provider to self-quarantine due to concerns. So maybe even if you didn't test positive for COVID, but you were advised by a healthcare provider because of your background history, your medical background history, or also if you're experiencing symptoms of COVID and are waiting to get your COVID test or your COVID results. That is another reason as to why you would be eligible for this time off. You're caring for an individual who also is quarantined or has been advised by a healthcare provider to self-quarantine. So this is also for people who are taking care of their spouse, maybe a family relative. It doesn't necessarily have to be a child whose school or childcare was closed. Also, and then the fifth is that the child of such an employee, which we covered, or the employee is experiencing any other substantial similar condition by the U.S. Department of Health. But really, the big ones are going to be 1 through 5. One of the things I did want to point out that's not on here that has been added as well is if you had to take time off to take the vaccine or to get the vaccine. Or let's say you received the vaccination, but you became ill, you got sick and had to take time off. They now have expanded this credit to allow that time to also be considered as paid sick leave. So that is something that's not on the IRS with this publication here, but it has been added. So if you have employees who have had to take the vaccine or you took it yourself, you want to make sure that you document that or that you have some type of record to show that you did get the vaccine. And speaking of record, one thing I would like to talk about here before we move on is explaining what you need to have to show this kind of sick leave. So one of the things that's important, of course, are any COVID tests that you might have taken, any documents from your medical provider stating that you needed to quarantine, of course, any vaccination record as well. And also we'll kind of get into how much the credits are. And that's another thing also that you will need to calculate your wages that were lost, meaning that a lot of the times with people who are self-employed, they don't really know how much they pay themselves on an hourly or salary basis. And that will need to be calculated to be able to figure out how much you qualify for this credit. So unless you are on payroll, these are things that will need to be considered as a business owner on how much you actually lost due to the sick time off. So speaking of that, how much are the credits? So to try to make it a little bit more simple, this credit here is for someone who was unable to work for reasons 1, 2, and 3. That, going back to the slide from earlier, that would be if you had COVID. It's not that you were caring for someone else, it was a personal quarantine or personal isolation. So because it is personal and it's affecting the employer or contractor, they do have a little bit more of a credit for each day that you lost. So for you to be able to qualify for this, you must either fall into the scenarios of 1, 2, or 3, and may receive paid sick leave for up to 2 weeks, no more than 80 hours. And this again would be paid at the employee's regular rate of pay, or if higher, the federal minimum wage applicable for the state or local minimum wage. So the most that they would pay you would be $511 per day. And I'm sorry, I noticed that I have a little typo on the presentation on that previous slide, but I will explain here in a bit. So this first one here, again, is going to be for yourself if you had to quarantine, if you tested positive, if you received the vaccination, and the most that they would pay would be $511 per day, and the combined amount would be $5,110. This is something that, again, if you don't pay yourself on a salary rate, on a salary or hourly rate, you will need to figure out what your rates are. And the most that you can get is $5,110. And this is actually a credit on your tax return. So I have seen this help a lot of business owners for tax year 2020 once we calculated this information. And for the second part down here, this is for reasons 4, 5, and 6 from earlier, which is for your family. Any family member or dependent who had to, you either had to care for, and this is going to be for up to 2 weeks as well, no more than 80 hours, and it's going to be at a lower rate. It's going to be 2/3 of the employee's regular rate, or up to $200 per day. I did actually 12,000. This is actually supposed to be 2,000. I apologize. So the most you can get for this credit is $2,000 combined. So I will make that change before we share this PowerPoint, but of course, this second credit here is going to be a little bit less because it wasn't directly the person, the business owner who was affected. And also, to answer a common question I get about these two credits, can you apply for both? And yes, you can apply for the credit for yourself as well as the credit for a family member. So if, let's say, you had COVID, had to quarantine, but then a week later had to extend your quarantine to care for a family member or dependent, then we can consider the time off for both scenarios. So it can be used for both. And again, guys, we didn't go into too much details with some additional payroll tax credits that you can qualify for. There are a few more credits for employers who have employees on payroll if they also missed work because of the reasons listed earlier. These credits amounts are only for individuals who are self-employed and file on their personal tax return. So for employers who have employees who they pay on payroll, those credits will be a little bit different because it will be based on your payroll taxes. It will be a credit on payroll taxes, which are paid every month or every quarter for a lot of people. So again, if you do have employees on payroll, you want to consider looking into that and also being aware of the times that your employees took to either recover from COVID or if they again got vaccinated and had to take some time off as well. Okay. And then the next thing I would like to cover here are if you received grants or loans in 2020 or 2021 now. So one thing here that I do want to point out is that grants on a federal level, because I know the city of Seattle and the state of Washington are taxing them a bit different, but when it comes to federal taxes, grants are taxable income unless you are a nonprofit. And this does include SBA grants or any other disaster relief grants that were issued. But because it is taxable income, you can also deduct the expenses that you used with this grant money. One of the things that has surprised a lot of people, though, is some of my clients have said, well, that grant money was to cover my salary and my pay. It is then important to know that you will have to pay federal taxes on your salary at the end of the year. So if you use that grant just to pay for your owner's pay, owner's salary, then you will have to consider the taxes at the end. But let's say that the grant was used to pay your rent or your supplies or your employee pay, then that should take care of any federal tax liabilities, since you will be able to deduct the expenses as well. This is a bit different from the loans. This year, we didn't see the PPP loans as often as we did last year, but this was still a common thing for a lot of people. Very important to know that as of now, the PPP loans were not taxable, but because of that reason, you also could not take any deductions from the business if you, let's say, use the loan to pay rent, and you use the loan to pay all 6 months of rent, then unfortunately you would not be able to take that deduction at the end of the year. So it is important to know that, again, the loan is not taxable, but the expenses are not deductible either. And if the entire loan was used to pay expenses, it will usually even out. And the only thing that you can deduct on any loans are the interest paid on the loan when it's time to repay it. But the reason why the IRS will not tax you is because more than likely you will have to pay this money back to the IRS. So that is the reason why, I'm sorry, not to the IRS, you'll have to pay the money back to the lender or whomever gave you the loan. If the loan is forgiven, which in most cases the PPP loan was forgiven, then that's kind of when it evens out. You don't report the income, but you also don't report the expenses, and it just kind of gets, taken care of there. I would definitely recommend that for your accounting or your bookkeeping, to make sure you are able to differentiate the expenses paid with the loan. That is when it is important to make sure that you are keeping good record of those expenses. So that is one of the things we wanted to talk about there. And lastly, just so we have time for any questions here, I wanted to go over the business expenses. I will take some time to cover a few more in detail. Of course, any salary or wages paid to your employees are deductible. Or again, if you are an S corporation or C corporation and you put yourself on payroll, your salary and your payroll taxes are deductible. And this is where you'll usually see the credits for employers. If they have employees that took the time off, they will be also generated on those payroll tax reports. Benefits, this includes medical benefits, any type of dental benefits. Those are also deductible as well. We have advertising. Meals, I do actually want to point out that they have increased the percentage of meals. And I also always like to mention what qualifies as meals. So if you are having a coffee by yourself, you go to a coffee shop, you're working, that is not deductible unless you have someone else whom you're meeting with. Let's say you meet with someone else and you're having a dinner to discuss any business topics or potential client, that 100% you can deduct the meals. But a lot of confusion here happens when you are working, let's say, and you stop by to get lunch. Those meals are not deductible unless you have someone with you or you're sharing the meal with someone whom you're either working with or a client. But that's a big confusion with meals. And then also it is important to know that they do want you to save this receipt for meals, and on the receipt have the business topic that was discussed during that meal and with whom you had the meal with. I will talk about any like audit situations and audit questions here in a bit, just because they have stated that they are going to be increasing audits by 70%, which is a lot. And unfortunately, the way the IRS works is they focus on business owners heavily. So they're going to be more concerned about a client who has a business tax return versus a client who just has a W-2. And I do also want to point out that with audits, the business bank statements are not always 100%, that's all you need. That's a big misconception that I have had with a lot of people. It is very important to save the physical receipt, even if it's on a business bank account. I have had auditors who are a lot more strict and they will not take the deduction unless they have the receipt. So this is very important, again, like with receipts like meals, making sure that you have that good habit of just writing that information on that receipt. Moving on to gifts, this one they also started putting a limit, whereas before there wasn't, where it's 25 per person. So even if you're gifting someone $500 or the value of the gift is more than 25, the max allowed is $25 per person. We have dues and subscriptions, commissions, cell phone. The other one that I wanted to talk about here is depreciation. Depreciation here, there are different ways in how you can depreciate your either vehicle is the big one that I see on here, your car, if you're using your car for business and, let's say you manufacture, supplies, and then you're driving to different venues to sell your products. There is different ways on how you can depreciate your vehicle. I'll talk about it in the next 2 slides also, but you definitely want to talk to an accountant or your tax preparer to figure out what's the best way to either deduct your business miles or depreciate your vehicle, or there's just different ways on how you can do your car. That one gets a little bit complicated, but you can also use a depreciation for big machinery. It can also be like a desktop, a laptop. I personally don't usually recommend to depreciate something if the value of it is under $1,000. At that point, you're probably better off to, just deducting the full amount that you paid at the time of payment for that a product or supply. Usually this one you're going to see more on bigger purchases. And there is also different ways on how you can depreciate them. So that's another thing that, if you purchase something big, you always want to ask this question to figure out what is your best way of deducting that expense. Then we have our legal and professional fees. If you are contributing into a pension plan like an SEP plan, which is specifically for business owners, or any other type of retirement plan, is also deductible. Bad debt, if maybe you provide a service and you are not paid for that service, or you're not paid for that job that you did, you can also deduct that as a loss. Business license and permits, any travel for any business ventures. I do also want to point out that with travel, it is important to have really good record of, if you're traveling somewhere for work, making sure that you're keeping some type of business notes, maybe business meetings, being able to show record that that trip was for business. That doesn't mean that you can't do any other personal related stuff during the trip, but it is important to have that to be able to show that you worked at least, and they are pretty strict with this, 8-hour work days to be able to consider that trip a travel expense. So, I have had clients who've been able to document, have documentation of that, but it is important that they want to show record of a work day. So if, we can go on with a whole different kind of scenarios here, but just making sure you keep really good record of that travel expense. And the next one I would also like to talk about is the home office deduction. This is one that I get a lot. I get asked this a lot, especially because of COVID. It is important to know that with this home office deduction is only applicable for people who are self-employed. If you are not self-employed, then this is not an option. If you are just a W-2 employee, unfortunately, this is not an option for you. And there are two different ways on how you can figure out this deduction. There is the regular method and the simplified method. And with the regular method, it divides the expenses of operating the home between personal and business use. This is usually when we'll have to ask a little bit more details about your actual expenses. And you'll see the form on the right-hand side on what we can use. You know, we have your mortgage interest, your real estate tax, you have your insurance, repairs, rent, utilities, etc. Usually what is recommended, if you're going to use the simplified, it has a base rate of $5 per square foot used for business from your home, and the maximum deduction is $1,500. This is usually a more audit-friendly way to go if you are using a smaller portion of your home for your business, or maybe let's say you have a work location somewhere else, and then you also have a home office that sometimes you work out of. The simplified is usually more common there. For the regular, I would 100% use this over simplified if, let's say, 100% of your business is from your home. Then that's when you're going to have a much bigger advantage using the regular method. And regardless of which method you use, the requirement to qualify for this deduction is that the area is exclusively used for business and regularly used for business, or the principal place of your business. So one of the big things I get here a lot is clients who work, from home, and then or maybe also do remote work, but they're working from their living room, or they're working from their kitchen. If it's a shared space like that, or your bedroom, unfortunately, that would not qualify under the home office. It needs to be a specific section of the home just used for that specific purpose. And from audits that I've had in the past, because it is your home, an auditor will not come to your house, but I have had auditors request pictures of the office or the office space. I do want to point out that this also includes storage. If, for example, you have a garage where you store your supplies and your equipment, then you will be able to use the square footage of the storage or the shed, or any additional buildings in your home that you've used for that purpose. But again, they can request pictures. A second thing that I've seen them request for this proof is your expenses. So making sure that they show record that you are on the lease agreement, that you are the owner of the home, that the utilities are under your name. They do not have to be under the business name as long as they're under your name. And one of the examples that they also have here is that, for example, if you have in-person meetings with patients, clients in your home in the normal course of your business, but also carry business on another location, you can deduct your expenses for the part of your home use exclusively for business. So this is a scenario for a lot of people who may also work remotely, also go to clients, house, or they're traveling, but also this big example here that I like to use are for people who work remotely, but come home and still have to send invoices, send, estimates, email clients, talk to clients. That all can still qualify for home office. So even if you are performing your job elsewhere, as long as you have, some record that you're also working in, in your home office, then you can take this deduction. The last thing I want to cover with this home office is the difference between direct and indirect expenses that you see on the right-hand side. This is the worksheet that the IRS requires to be filled out. You will need to know the square footage of your entire home and the square footage of the office or workspace. The difference between column A and B is direct expenses, meaning that your home is required for your business. If you do not have this home office, your business cannot be performed. So this area I would exclusively use for people who are only 100% working from home, whereas option B, indirect, would be for the client to have a combination of remote and home. I would not use direct if you're not working 100% from home. And the reason why there's a difference there is the amount that you can deduct. The direct expense will give you the 100% equivalent of what you're paying based on the percentage of square footage, where indirect, you only get a percentage of those expenses. So very important there. Again, hopefully we'll have some time. If you guys have any specific questions here, I'd be more than happy to answer. And lastly, we're going to talk again about the car expenses here. Again, we cannot double dip. So if, let's say, we are depreciating the car, then we would not be able to use these expenses the way we're using them here. You can still deduct the mileage when you depreciate your vehicle because it will be asked, but it's going to have a different rate. So for the expenses on your car, assuming that you're not taking the depreciation on your vehicle, we have two options. This is going to be more common for our Uber drivers or Lyft drivers. But of course, again, even if you're not doing that and you're using your car, you can use these expenses. You have the option to either go with your actual car expenses and get the sum of repairs, fuel, car insurance, your tax renewal, your auto loan interest if you are paying a loan on your car, or the mileage deduction. But it has to be one or the other. And that's when you'll have to figure out which one benefits you most, which one may give you a higher deduction. I do want to point out that with the mileage, they have decreased the rate. It did go down by 1%. It used to be 57 cents for each mile driven, and now it's 56. And the last thing I want to say for this one is your commute is not considered a mileage deduction. This is only if you arrive to your workplace and then from there have to go to a different location. But it does qualify if you, let's say, are a housekeeper and you're going from one place to the other, that definitely qualifies as mileage. The guys, we don't have that much time left. I think here we have about 10 minutes or about 5 to 7 minutes for questions. I did want to take the time to hopefully answer any questions that you guys may have. Anything specifically that I might have not talked about as well. I don't know if anybody had any questions for this topic. Okay, I don't think I do see any questions here, so I believe we'll have time to do a survey as well.
Thank you, Abigail. Yes, I just put the link to the survey in the chat. It is really appreciated to get your feedback and your thoughts. So please go ahead and fill it out when you can while we wait for questions from the audience right now.
I have a question. So I have done a lot of Venmo transactions and it's not real receipt what I have. Would that be a problem when I file for expenses with that? Do you know?
That's a great question, Mari. So question, is this for expenses that you've purchased?
Yes, for the business. Yeah.
For the business, yes. So that's a great question. Yes, that would suffice, assuming that you have the receipt, or not receipt, I'm sorry, but the transaction, but you have to make sure that there is a detailed memo. So if you just put an emoji, that I don't think would be sufficient, so you want to be as descriptive as possible
Okay.
with doing these payments through Venmo.
Okay. Yes, I did specifically write what I purchased for. Okay. Sounds good. Thank you.
And I do want to take the time really quick now that she mentioned Venmo. Very important, guys, if you are taking payments through Venmo, Cash App, or any other, online maybe not, they're not even considered merchant accounts because they're usually free. The IRS has made it a lot stricter where now they're going to start sending out 1099s like Square does before the minimum amount that they would issue you a 1099 is if you made over $20,000, but now they've decreased that amount to $600. So if they're seeing activities in and out of Venmo and clients are paying you there, and before that was something that you wouldn't deposit into your business bank account, they are going to get a lot stricter with that. So just please be mindful of that, keep good record, and expect them to reach out with information. They're going to start requiring verification of identity for a lot of these options on receiving payments. And thank you, Lux, for sharing that. QuickBooks does have a cool feature where they can keep track of your mileage. I would highly recommend that, as well as Miles IQ is another big one in case people don't have QuickBooks on how to track your mileage. Thank you for sharing.
Does anybody have any more questions? If not, we can go ahead and wrap up and early and give you all the gift of time. And then one more announcement that I have is that Agribusiness Week continues on Wednesday from 6 to 8 p.m. with our client panel and virtual networking. The link is in the chat to sign up for that, and it's again via Zoom. So we hope to see all of you there. And thank you so much, Abigail, for this very informative presentation. It was recorded, so we'll be sending that out as well.
Thank you so much.